Let's talk about loan refinances. So this is a big topic because it has a lot of depth to it, and it's a very important strategy to understand, but it also is important to understand the nuances that goes into it, such as the tax consequences, the costs of doing so, and the overall strategy behind it. So first of all, what is a refi or a refinance? So this is basically when you originally bought the property. Let's just use a simple example, a $10 million property with a $6 million loan. And then over some time, because of the market going up in value, your rents are higher, you did a business plan where you did some renovations, you increase the value of the property. Let's say the property value is now $15 million. And so you can go and get a new loan now at a higher amount than your existing loan, which is going to be able to not just pay off your existing loan, there's going to be excess capital above and beyond the payoff of your existing loan, and that's going to be considered cash out proceeds. So this is the dream scenario when people talk about refis. They talk about a cash out refi, and that in itself is the strategy, right? Typically people don't romanticize or strategize about cash neutral refinances, or even worse, cash in refis, which is maybe another topic that we might cover. But with a cash out refi, like I said in the example, you started out with a $6 million loan, and let's say you put on a $10 million new loan on the property, you're gonna have $4 million of excess capital. Now, that's not quite exactly true because you are gonna have closing costs. And so it is expensive typically to pay off a loan, and it's also typically expensive to put on a new loan, right? Financing is just expensive. There's closing costs, title fees, there's broker fees, lender fees, due diligence costs, inspection costs. You know, everyone's gotta get a piece of a big refi. But just to keep it simple, like that $4 million of cash out proceeds goes back to the partnership. And so in the context of a private syndication, we would take those cash proceeds and distribute it back to investors, and investors would have a big win because they would be able to get some of their capital back, some of their original investment back, but they're not being diluted, so they don't actually change their ownership percentage in the deal. So there's no downside here. The upside is, of course, you get some of your capital back, so you value the time value of money, you get your money back. The other valuable element of a refi is that it is not taxable, because when you are getting cash back through a refi, that is debt financing, and so debt is not income, so it's not taxed. So this is something that people really love. You know, people in the zeitgeist right now like to talk on Instagram about how, oh, the rich, they buy, then they refi, they never sell, they hold forever, and this is how the smart rich people operate, and this is definitely true to an extent. But of course, there's more complexity when it comes to estate taxes and trusts and things like that to really make it happen. But refi is a powerful strategy where you can be more tax efficient than buying, selling. And just in general, holding longer term can really allow you to compound over time more efficiently. And then of course you layer on a 1031 exchange, and now you're really cooking. You've got depreciation, you roll over the depreciation recapture. You can watch my 1031 exchange video in more depth to get a full scope of that. So that's one strong piece about refis, but there are downsides. And so, for example, this year we did an excellent cash out refi on one of our favorite properties, Preserve at Copperleaf. And this is a deal that we held for just over a year, and we created so much value in that year because we bought the property right, we got a property tax exemption, and we increased the income of the property because we were able to massively cut expenses and just operate more efficiently. And we were able to go back to the bank and get a new loan, and we were able to do a massive cash out. We got like over $6 million in proceeds. We were able to return nearly 50% of an investor's original capital. So a year ago, they put in $100,000, and then about a year later, they get back $50,000. It's not taxable. They can go take that $50K and invest into another deal. Not saying every deal is gonna, double, triple, and be a home run, but at least you can get another single and double out of it, which is super valuable to do with your cash out proceeds, because that's how you're able to actually really justify it and compound your wealth. If all you do is just take the cash out proceeds and go spend it, well then you probably would have just better off keeping the money invested in the deal originally, because yes, the property went up in value, but when you're refining, you're only partially monetizing the value with the property, right? A sale would fully monetize the value, but a refi, it's only partial. So it's important what you do with the rest of the money. And if you actually underinvest or underperform on the cash out proceeds investment, then yeah, you would have been better off actually not refining at all. So for example, let's say the deal that you're in, you've created the value. So this is something pretty hard to understand, so try to follow this, because what people mistake is they stay in a deal and think that what just happened is going to keep happening. So for example, when we just increased the value of Preserve at Copperleaf, we bought the deal for $34 million, property got appraised at refi for $53 million, and that's amazing, but that's not going to happen again, right? The next 12 months and the next 12 months. It might not even happen over the next 5 years. So the big J curve in value creation happened in the initial term, and that's where it makes sense to do the refi to capture that value creation. So you have to be very realistic with what you think the return is going to be moving forward. So on Preserve at Copperleaf, for example, now that we've executed the refi, we've really pushed value, we still think there's a lot of meat on the bone, and we're just in a very favorable part of the market cycle where there's undersupply coming our way and there's just going to be persistent rent growth. So it's a very strong opportunity for us to hold. And to kind of keep it simple, let's just say we're going to see about 4% appreciation, we're cash flowing about 8%, and so we can expect maybe a 12% return per year moving forward. Now, some people might think that's aggressive, some people might think that's conservative, but let's just use that for the sake of argument. So if by staying in the deal, our equity is growing at 12%, very good. And that's actually quite rare, and that just speaks to how strong of a deal this particular investment is. So, and we can use another example soon to kind of counteract it. So, but if Preserve is actually growing and returning at 12% total investment, you have to look at your cash out proceeds and say, I actually have to beat that 12% in order for it to be a better investment and for the refi to make sense. So for example, if someone put in 100K, now they get $50,000 back, and then they are essentially, let's say hypothetically, earning a 12% go forward return on their residual equity, the 50K that stayed in the deal. They need to take the 50K cash out that came out of the deal, and they need to go and put it into a new investment that hopefully is projected to return a 15% IRR or a 16 or something like that. That's better than the 12. So there's of course reinvestment risk, there's also time, you got to find the right deal, but it's possible. Now, in that situation, actually looking at those numbers, you might make the argument that, hey, I don't want to refi my equity out. I like the deal. I like this exposure. I want to keep my full 100K in. And that's a very fair comment. And that's actually some of our investors in Preserve at Copperleaf, because they're savvy and they've invested with us, many times. They said that very same thing. They said, hey, I actually really enjoyed making 8% on my $100,000, which is $8,000 per year in monthly distributions, versus now with 50% cash out, they're making 8% on only their $50,000. So their monthly distribution to their bank account actually got cut in half. So investor might just look at their distribution only and go, this is actually worse. I actually enjoyed the higher distribution. I don't care about the money that came back, right? I invested because I wanted to put the money out. I didn't want the money to come right back to me. And that is actually the sign of a very smart investor. Typically newbie investors, they want to flip really quick. They want to put their money in, take it out, and move it on to the next and chase the trend. And that usually results in excess fees and costs, because every move you do has a cost. And that's going to chip away at your returns. Smart investors, they find a deal they like, they find a sponsor they like, and they invest and they wait. So we did have people reaching out saying, hey, this refi, I know you guys are making it sound like a great thing, but is it really such a great thing? And our response was, yes, it is a great thing. We do think it's overall accretive. And on top of that, we structured the deal in such a way that we kind of had to refi anyway, because we closed on the deal with a bridge loan to give us the flexibility to do the refi in the first place. Now, a bridge loan is kind of like 4-letter word these days, and I don't blame people for thinking that, because bridge loans are much riskier than permanent financing. Typically our preference is to do 5-year or 7-year financing, which definitely reduces your risk. But with a bridge loan, it's only typically a 2 or a 3-year loan, and that creates a bullet maturity problem where you really have to get your act together in short order. In real estate terms, 2-3 years, that is a blink of an eye, and that doesn't give you very much time to implement your business plan. Everything has to go right, and the market cannot go against you. And unfortunately, that's what we saw a lot of people happened to a lot of people in the 2021-22 era. They financed with bridge, they bought at the peak of the market, they paid top dollar, they financed at a very aggressive leverage point, and then they only had 2 to 3 years to make it work. And now they're kind of stuck. They're dealing with negotiating with the lender for extensions and so on and so forth. It's a very difficult situation that's going to continue to play out over the next handful of years. Problems in real estate don't go away overnight either. Success doesn't happen overnight, and problems don't go away overnight, unfortunately. But back to the refi scenario. Basically, we told investors, hey, this was the plan all along. We had to close with a short-term loan in order to be able to do the refi. Because if we had locked ourselves in, going in with a 5-year fixed rate loan, yeah, that's great, yeah, that's conservative, but we would have been effectively locked out from being able to capitalize on the partnership structure where we actually did the tax exemption strategy, and also we wouldn't be able to do the refi to monetize the near-term value creation. So the situation being going in bridge loan where you have to take it out. You don't want to stay on the bridge loan. Bridge loans are expensive. You're paying higher interest at a floating rate. We're able to refi into a fixed rate, which is great because we like to reduce variability in the deal as much as we can. And it actually reduced the interest rate. So we're able to reduce interest costs, lower risk, extend term, and the cash out was just really the cherry on top. We would have done the refi even if it wasn't cash out. So the cash out was just a cherry on top. And also another thing about cash outs is they can be manipulated. Not to say I don't think people do this all the time, but for example, you might see online someone brag about, as just I was, talking about a 50% cash out refi, right? It sounds amazing. The holy grail of refis is when you actually do 100% cash out. Imagine that. You put your initial investment in, let's say it's $100,000 or $1 million, and then you implement your business plan and you do a refi, and the refi, the new loan compared to the old loan, is so big that you're able to actually get all of your original investment back, but you still own the property and you still get the monthly cash flow. That, to some, is the holy grail of investing, because they want to just collect properties and they want to put their money in, cash it all out, continue to own this cash flowing asset that's going up in value over time, and redeploy their equity into the next deal. And they're just playing Monopoly. So they're just stacking and stacking and stacking. And that's wonderful too. Although I do think in certain cases and at some point of time long enough into the deal, it just makes more sense to sell. But that's a topic for another day. So that kind of covers the pros and the cons, or at least maybe the perceived cons of a refi. Now I want to talk about the calculations associated with cash flow from a refi. So it's very simple when you just don't have a refi scenario. If you put $100,000 into an investment and it's cash flowing to you at $5,000 per year, it's very simple. That's a 5% cash on cash. Now, where things get complicated is when you do a refi, because now let's just use a simple example of a 50% cash out. If you initially put the $100,000 in, but now you have a 50% cash out. So now you only have $50,000 invested in the deal left, and you've got $50,000 of cash back in your pocket. And let's just, to make the math super simple, let's say your $5,000 per year of cash flow drops down to $2,500. So technically speaking, the correct way to look at that would be you are still cash flowing at a 5% cash on cash. So yes, your dollars went down, but the percentage is the same. And you should be analyzing these things from a percentage basis, because you can't look at just the decline, because it's not fair, because you have the $50,000 cash in your pocket. You can go and put that into another deal, and let's say that generates 5% cash on cash. Okay, now you're back to your $5,000 per year, just to kind of make it make sense. So, but the other way to look at it though, is that's your return on your residual equity, your remaining cash in the deal. And there's another thing to look at, which is your ROE, or your return on equity. And so this is, I don't think people really think about this all the time, but basically once you refi, there's more murkiness as far, well, really there's truly always murkiness as far as what your real equity is in the deal versus what your hard cash is in the deal, right? Because just because you bought the deal at 50 million and therefore you put in $25 million of equity into the deal, doesn't mean your 25 million is worth 25 million, right? Even though real estate doesn't have a stock ticker and it moves up and down every second like a stock, it does go up in value every second, every minute, every day. And so a year from now, you might be looking at the project and your 25 million is actually worth 26 million, or it might be worth 20 million. And so that would be your true equity in the deal. And so when you refi, this can become more important to understand, because you're looking at your residual cash in the deal, but then you also need to look at your equity in the deal. And you can actually, when you analyze that, you could actually find out that the return that you're getting is not as good as you think. You might actually be over levered, you might be under levered, and the deal doesn't have the same juice that it did when you actually created that value going through the J curve. But it might have a very good cash on cash because what you have is a little bit of equity left in the deal. But it's just not the full picture. To make it more dramatic, let's say you did a refi where it was a really successful, you put on a lot of debt, compared to the old amount of debt. And so you put in $100,000 and then you cashed out, let's say $90,000. So you only have $10,000 left invested into the deal. And let's say it cash flows $1,500 a month or $1,500 per year. That's a 15% cash on cash. Anybody would be very happy with that. They would say, wow, 15% cash flow, this is amazing. This is a fantastic deal. But you have to actually understand what is your true equity in the deal, because yes, you only have $10,000 of your capital in the deal, but if you sold it, what would be the actual amount of money that you would get out of the deal, out of the sale, right? So maybe 10,000 is your hard equity, but maybe the property's gone up in value such that if you sold, you would get $100,000 back. Now, if you calculate the cash on cash based on your true equity, not your hard equity, then you say, okay, $1,500 of cash flow per year divided by $100,000 of true equity, right? That's only a 1.5% cash on cash. You say, wow, this deal is actually very thin. It's not doing that well. In this case, your ROE your return on equity is actually less than your cap rate, and you're actually better off selling, because when you sell, you will get your $100,000, and instead of now receiving $1,500 per year, you could take that $100,000 and put it in a deal that can return 10 to 15% IRR, and now you're talking about, instead of making $1,500 per year, you're on pace to now make $10,000, $15,000 per year. Now I know these numbers sound small. Just add a zero if you're a big shot and you want to think in terms of millions, 10 million, 100 million, but the numbers are the same. And so this is something that requires a little more understanding when it comes to refis and overall buy and hold methodology and strategy. And that's something very important as you're evaluating the market. Is this a time to refi? Is this a time to sell? And really understanding why.